Most people believe banks simply store money. They think banks keep deposits safe until they are withdrawn. But modern banks do something very different. They create money from nothing. This hidden process affects inflation. It affects debt. And it affects the value of your savings. Yet very few people understand how it works. When you deposit money into a bank, you assume that money stays there. You believe it waits quietly in an account. In reality, it immediately enters the financial system. That deposit becomes the starting point of expansion, an expansion that most people never see. Money begins to multiply without printing a single bill. Most people think banks lend existing money, money that already belongs to someone else. But modern banking does not operate this way. Banks function under a system called fractional reserve banking. This system allows banks to lend more money than they actually hold in reserves. Only a small portion of deposits are kept aside. The rest is used to create loans. Those loans introduce new money into the economy. Imagine depositing $1,000 into a bank. The bank keeps a fraction of it. The remaining amount is lent to someone else. That loan is spent in the economy. It is deposited into another bank. Now the process begins again. The second bank keeps a fraction. It lends out the rest. Money continues to expand with each cycle. No physical cash is moving through this process. Most of this money exists only as numbers. Numbers recorded in digital ledgers. Money is created through accounting, not through printing presses. This is how modern money is born. This system has deep historical roots. Centuries ago, goldsmiths stored gold for customers. They issued paper receipts for deposits. Over time, goldsmiths noticed something important. Most people never withdrew all their gold at once. Trust kept the system stable. Goldsmiths began lending more receipts than the gold they actually held. As long as confidence remained, the system continued to function. This practice evolved into modern banking. Physical backing slowly disappeared. Trust became the foundation of money. Today, central banks oversee this structure. They influence interest rates. They guide monetary policy. But central banks do not issue most money directly. Commercial banks create money every time they approve a loan. There is one critical detail in this system. Banks create the principal of loans, but they do not create the interest. Interest must come from existing money. This creates constant pressure for new loans to be issued. Debt becomes necessary for stability. The system depends on continuous expansion. Without growth, stress begins to appear. As money supply grows, each unit of money becomes less scarce. Purchasing power slowly declines. Prices rise over time. Not because goods change, but because money loses value. Those closest to newly created money benefit first. Banks and large institutions gain early access. Advantages appear before prices adjust. Ordinary people receive money later. By then, prices have already increased. Savings buy less than before. Wages struggle to keep pace. Debt becomes normal. Saving becomes increasingly difficult. Most money in the modern world is created through debt, not through government printing. The system relies on confidence. Confidence that money will be accepted tomorrow. Confidence that trust will remain intact. History shows what happens when trust breaks. From ancient empires to modern financial crises. Understanding this changes how money is viewed. Money stops feeling neutral. It becomes a designed system. Banks do not simply store money. They actively create it. If you genuinely like this video, do subscribe. Join us in this incredible journey of finding